the two or three that I'll talk about are necessarily better than the others on the list. It's just going through the list, they seem to have some interesting things about them. And I'll start with Madrona. They have an interesting and consistent record of investments getting to IPO, which struck me as a little bit of a standout among the 10 that we picked. Those companies include Redfin, Smartsheet, Aptio, and Impinj. One of the other interesting things is that all four of those companies did pretty well after they went public. I mean, not necessarily that they're setting the world on fire with their stock prices, but they are. Three of them are still public. One of them got taken over by a private equity company. So I thought that was sort of worth noting, just the ability to pick investments that get to IPO consistently. The other thing that's notable about Madrona is they have a fairly consistent fund performance. 5 of the 6 funds that we looked at were were in the top quartile of performance, and the 6th was in the second quartile. And then the other thing that's just worth throwing out there for Madrona, they have quite a long track record. They were a very early investor in Amazon, and so there's a sort of a durability of success there, which stood out to me. So that's kind of the reporting. What Amir and Zoe's reporting sort of drew out. That's one of the ones that stood out for me. Another one was Anthemis, which I thought was kind of interesting because they're an example of a very active fund, and also they've sort of picked an area where they've become quite strong, and that's finance. They do a lot of investing in areas close to finance, whether it's insurance or personal finance as well. And I think that's interesting because it sort of suggests that they're really focused on areas with a lot of potential. As we all know, personal finance and personal finance fintech startups are there's a lot of them. There's a lot of them growing quickly, and it's a pretty active area. And then they also have this very standout investment in a company called Climate Corp, which sort of really interesting sort of merging of technology and agriculture and insurance, which is worth looking into if you're not familiar with that company. And then the third one that I'll mention is First Round. Again, a very active fund. And they have a nice history of really good exits. Looker, Flatiron Health, AppNexus, they all exited. Those companies all went out at 1.5 billion or more. And they have a really nice and strong portfolio of current holdings, including a company called Notion, which if you haven't tried it, it's actually a really interesting productivity app that has a lot going for it. It's a lot of fun to use. I'm using it to project manage my son's applications to college. And also,
it's like a gazillion dollar valuation.
Yeah, it's up high. It's almost $1 billion already, and still going strong. I think they're turning away investors rather than looking for more money. And then the last thing I'll say is that they have a very conscious focus on very early investing from the reporting that we did. I'm not 100% sure about this, but they seem to not have quite as wide a breadth of investing, but they're very focused on early investing. And if in any case, they do have a strong focus on early investing, and it's working out well for them. So I'll stop there.
Great. And just so you guys know, I took the deck off so that you could see us as we were talking, and that was essentially those were our slides. So anyway, now we get to have a conversation. With that, Tribe, Jay, do I need to unmute Tribe? Okay. Hey guys, it was really fun to work on this with you. Please, fill in the gaps or even beyond that about why you also set out to do this work and what jumped out to you about the data.
Yeah, so my name is Arjun. I'm one of the co-founders of Tribe. Jonathan behind me as well. And then Jake here's one of the partners who focuses on data science. So to take a step back and give you guys a little bit of a high level, we kind of pride ourselves in looking at data, primary as well as third-party services. And given that we're an early stage venture fund that invests across multiple stages, I would say Series C through even up to D, we really care about the life cycle of a company, the partners that they choose, and how they succeed over time. And I think the word life cycle is really important in that. And so when a company first raises its pre-seed or seed round, who the partners are, as individuals, the entities that support them was kind of what we set out to do. And we'll talk a little bit more about that. And we've had a history of building out these systems and architecture over the last 6 years. Previously at our fund, Social Capital, now at Tribe, and using third-party data services as well as primary data sources is what we like to look at holistically. And it's been really important for us as we have invested in companies in our investment track record. So companies like Front, Carta, Slack, even Cloud Kitchens sort of came through these methodologies of us understanding product market fit, as well as understanding who's a good investor and who are co-investors and partners. And the thing that's kind of interesting, and I'll echo what Jessica had mentioned at the seed stage, is that most of the data that people look at out there are price rounds, and the other way to take a look at it are how much capital is going into the valuation stages of companies. So it could be a note, it could be a price round, whatever it might be. And so actually our data kind of concludes that there's about 25,000 investments just in the United States alone that include pre-seed as well as with a note as well as a price round. So taking an aggregate versus just a price round, which PitchBook has. And then worldwide, it's around double that. Right? So if you have a lot of noise and you have a lot of seed investments, what's the approach that you take as investors to understand where you should spend your time and what that aperture may look like? So that was the approach we took at a high level as investors of where we should look for companies, who we should partner with, but more importantly, also founders of who they should partner with and who they should work with, because investment frequency is important. The type of sector and stages that investors invest in are important. And it's not just about seed investors and seed firms, it's also firms that invest in seed. So as Chris and Zoe, Amir, and Jessica pointed out, you had firms like Kleiner, Excel, Sequoia, where you might think of them as non-seed investors, they were also investing in seed. So a lot of the work that we did to talk about the seed investors was about who invests in seed versus who are seed investors.
Yeah, just, a little bit more on sort of motivation for why we did this. As we've set up Tribe, sort of one of the things that Arjun mentioned, our long history has really been in trying to figure out how to find the best mix of sort of modern data science, modern quantitative thinking with really, the best of what traditional venture capitalists do. And so as we've been, pulling together our firm over our first sort of year and a half of business, one of the things we thought a lot about was like, how do we just organize the world of seed investors? And, given our sort of history of thinking about the world super quantitatively, we naturally, looked at seed investors and thought, can we think about them in a quantitative fashion as well? There's, a very well-known list out there. A lot of people refer to the Midas list as being sort of the definitive list of venture investors. We dug into that and it ended up just not being super useful for us. And the reason why is because if you dig into how the Midas list is constructed, it's very highly curated, and it's the methodology is pretty deeply subjective, which I think is not terrible, but it just meant that it wasn't a super useful guide for how we spend our time, sort of how we help our portfolio companies, find other partners. And so, we set out to find a way to organize the world of seed investors in a way that would try to increase objectivity and reduce bias. And that was really the goal. And we, chatted with the information about it, and, something that was interesting to them as well. And that's sort of the genesis of this work. It's probably worthwhile for us to spend a little bit of time talking a little bit more about the methodology. I'll let Jake kind of talk about that. We'll try to keep that part not too long because it could be very detailed, but
Yeah. So I think we've got like a lot of, just going back to what the information touched on, a lot of it was on the final case, the final outputs, and maybe it's helpful to talk through a little bit of the concepts that went into our approach. So just reminding is we were looking for a way to be objective about finding seed investors that are doing special things that might matter in different ways to different people without being super biased toward the people who might be right in front of us. And so for like some examples, like when you start doing this, you realize right away that there's not like one type of good investor. For example, one investor might have like a humongous return on one of their investments, but the rest of them might not be super special, which is fantastic for LPs because we know that in VC, most of the returns come from just a few companies. But if you're an entrepreneur and you don't have a product yet and you need a few rounds for product development and testing and all this stuff, it's kind of a different type of partner. And if you're somebody else that just wants a fast check and just wants to get back to work, again, it's a little different. It's also pretty different from what an LP might be interested in. So, going back, we wanted to find a statistical way of combining several concepts that capture and proxy in good investment processes. And that's also important because it's not just, there's a huge amount of variance involved here too, and how do you control for that? And a good process is something that if you repeated it many times, on average, you'd do well. But a good outcome could be from all sorts of things. So basically, we're really trying to find outliers without being super stuck on pure returns, which have a huge amount of variance. And so at a high level, I think, Jessica outlined some of this, but we're looking at exits, fundraising, and activity. And we break that out in multiple different ways, but that's, I think, at the highest level we looked at. And scoping down, so Arjun was mentioning that there's 25,000 or so entities investing in the US. We ended up looking at 2,000 because that was the number that we had enough data on to be able to conclude statistical confidence on. And so, without getting too deep into the statistics we use, basically what we're trying to do is we're trying to answer how likely is a given investor a very good investor, not the best investor. We're not looking at that perspective. It's more understanding that we don't know what everybody wants, but is somebody doing something special, and how confident are we? So that's really behind the model, our thinking. And it's still a work in progress. We're looking at other ways of proxying other things. This is really looking at more the established players, but we're getting deeper on finding very young firms through who are they co-investing with. But at the moment, that's just kind of where we are. We're pretty excited about where it's come so far. There's a little more context on our site, and you can reach out if you have any interest.
We should point out that on our site, there's also a link. Although the top 10 has been shared with the information there, we do actually have a much more fulsome list, going 100 investors deep. And if you go to our website, you can sort of you can request that.
Great. Thank you, guys. Okay, so we've come to the question portion, where would love to talk about any aspect of this that interests, from either the list to the trends. And Jake, remind me, so to do so, if you see in your right hand, you might see a raise hand. Is that correct?
Yeah, down by the participation in the bottom. If you're in the Zoom app, there's a hand raise option, and that'll raise a blue icon, and then I will unmute you.
Great, let's give it a try and see if we have any questions.
Or if you just want to comment in the chat, I'll unmute you as well.
That way. What questions? Well, we have some pre-submitted ones that we can definitely go to.
Now.
Okay, great.
All right, so Nancy, I'm going to unmute you.
Hi, Nancy from Bond here. I'm just curious how you think about ranking these or sort of selecting these for different subsectors, since in the seed stages, your domain expertise matters so much. And I think it'd be pretty interesting to see the cuts of data for fintech or for consumer, like Forerunner, for example, isn't on the top 10 here, but I'm sure if you did it for consumer, they would show up. So just love to hear you guys speak about that.
Yeah, I could start. So we scoped this to the United States, right? So we basically said who is investing in U.S. domiciled companies. And that segmentation, you could apply anything, right? So the thing you're talking about, we could just cut it by sector and rerun our analysis that way, and we would get different lists, and it would totally, I think what you're touching upon is exactly kind of the principle here is people care about different things. Can we come up with an approach that if we had a specific question, we could dig into that question? And the answer is totally. So if you were like, I'm really interested in consumer seed investors, yes, we can go and measure that, and it will be scoped that way, and we'll have our different confidence levels in different ways, but the framework is basically unchanged. Yeah.
Yeah, and part of the beauty here is that we're starting off with a generalized approach, but we can go deeper and deeper as needed for the questions that a certain customer might have, right? So if you're an LP, what do you specifically care about? What are the sectors you care about? If you're a founder, who are the investors that actually invest in my sector, or who are the ones that are starting to trend in my sector? All those pieces can be cut because we start off with a large data set, especially at the seed stage, since there's just a large amount of capital that gets deployed into a large amount of companies that get deployed every year.
I think this is also part of the reason why, we wanted to do this stuff from the point of view of actual data sets. When I mentioned before that we had found shortcomings in the Midas list, it was partially because other methodologies that don't rely on data wouldn't allow themselves to be cut up in the way that, you're suggesting. So it's definitely something we could do and something we thought of.
And we're working with Tribe to publish more, so stay tuned.
Awesome. Liam, I just unmuted you.
Hi guys. So I guess my question is really about what kind of tangible, so for somebody who's looking for pre-seed money, what kind of tangible metrics are most important? Like what do you prefer to see the most hammered down before you start meeting with people, just as far as like preliminary projections and things like that? It seems pretty, at least from what I've read, sort of unclear this early on. So I was just curious if you had any input on that.
Yeah, sure. This is Arjun at Tribe. I think part of it is if you're a pre-seed or seed stage company, here are the things that you care about. One, who is going to invest in your pre-product market fit company? Who's willing to take that risk? What is the outcome of what you're looking for? And what type of investor invests in your category? And then the last question, which is probably the most important question you should ask, is do they invest at all anymore? And that's part of why we came up with this in the first place, which is, do you want to talk to an investor 10 years ago that had a high track record but hasn't invested in 7 years? Or do you want to talk to the investors that are at a higher frequency of investing but also have a good track record and might care about your space? And so the list that you saw now is, it's kind of like the top 10 investors, and they're more generalist investors. But as Jake mentioned, there's 25,000 entities, and out of those 25,000 entities, pretty positive there's someone who cares about your space at the stage that you're at the valuations that they care about. And we can cut that data to sort of be more helpful. And at a high level, depending on where you are as a company, and I don't know enough, obviously, is it's what's the size of fund also that's going to be approaching you. Is it a sub $25 million fund? Is it a solo GP, 50 million and below? I would say typically any fund that's 200 million and below is enough of a target for you to start building a relationship with and talking to.
Okay.
Prashant?
Hey everyone, thank you so much for your time. It was a great session so far. I have one question. It's in fact pretty broad, and I want to deep dive into a certain sector, which is SaaS. So I just want to try and understand more data on how many SaaS companies were funded, what was the average check size, and typically what are investors looking for at the seed stage today in terms of ARR, right? Like a few years ago, it was $1 million ARR. So what are they typically looking for at this point in time? And what verticals, and by verticals, I mean what domain in SaaS is hot at this point in time? Thank you so much.
Yeah, we'll try to tackle. It's a fully loaded generic question. But at a high level, I think what's really important is the way we think about the world is you bifurcate into two. You are either selling to an enterprise or you're selling to a generalized consumer. And then within enterprise, you have top down, bottoms up, and mid market. And in this world of what we're seeing today around hot is people talk about SaaS. Typically what they're talking about is a bottoms up software enabled product that they're selling. What's hot is a pretty lagging indicator. So I don't think we'll try to go too deeply into it. Some people say fintech, some people say energy markets, some people say insurance and property tech. I think the main thing you want to look at if you are starting from scratch is what is a big bottoms up market or TAM that you're going after, what type of problems that you're solving, and what is a business model that makes sense for that sector. Sometimes it could be transactional SaaS, it could be reoccurring SaaS, or it could be just like high ACV type of top-down type of SaaS that some people sort of talk about. In terms of ARR, again, it's another fully loaded question. We actually write about this a lot in context. We call it our quantitative approach to product market fit. We have a approach where we name branded the 8-ball of heuristics and things that we care about. Each sector will look different around what's the healthy product market fit. And Jonathan can step in here and talk about some of the companies that we've looked at. But as investors, and this is our opinion for what it's worth, other investors will tell you different things. Pre-seed, seed, and Series A mean different things for different investors. And so I would really kind of urge you to think about where you are in your life cycle as a product or a company, and who are the types of investors you want to talk to, and what is the type of risk attribute that they have at your stage. And so if you're starting a company from scratch, these days people call it pre-seed. 10 years ago, they used to call it an angel round. But I'll let Jonathan take into some of the things that we care about from a SaaS perspective. And we might be able to hit mid-market, bottoms up or top down.
I think there's a little bit of there's an implication based on actually the first couple of slides that Jessica showed. There is a lot more money, right, in the seed and Series A ecosystem, particularly in the seed ecosystem. What that means is that, if you kind of rewind the clock maybe 10 years ago when there were fewer seed investors and fewer Series A investors, they might say, the only way a SaaS gets done at Series A is at $1 million of ARR. And since there were only 5 SaaS Series A investors, they all kind of did that. But nowadays there's many more investors. And so, any claim as to like what one benchmark would be becomes not really relevant anymore, just because there are so many different investors right now. And that's sort of a broad trend, right? The more investors there are, the more different things could qualify as being reasonable. We've seen things going up for Series A with like less than $100,000 of ARR. And we've seen things going up, SaaS companies, things go up for a Series A at like, $3 million of ARR, and really everything in between, and if anything, the macro trend is that the spread of what's possible, at any, named round, those spreads have gotten larger, which is, I think good for entrepreneurs, right? Because it kind of gives you the sense that there are more ways for you to be able to get your company funded now than there ever have been in the past.
Well, looks like we have one more question from Gil.
All right, thank you. So I'm interested if there's been a structural change with the larger VCs being able to invest in seed rounds and pre-seed rounds. Is this a new phenomenon? Because I remember in the old days they would have scouts that were sort of surreptitious. They would put money into other funds, but a big fund, how does it justify making small investments when it's got such a big fund?
Yeah, we'll try to take this again. So I think the way to look at the world is how do you underwrite risk, and at what stage do you start investing? So if you are a $100 million fund and you invest in Series A, you'll look more concentrated because you'll have a certain amount of loss ratio, which means a certain amount of companies will fail. And the same thing will happen as you get higher and higher, larger and larger funds. I think the reason why some firms invest earlier on is to try to understand, are there any signals for them to deploy more capital in order for them to return their larger fund? So there's kind of this rule of thumb. I think Josh Koppelman, when he was one of my investors, used to say, if you're $1 billion or $1.5 billion fund, you essentially have to invest in $25 billion of market cap to return your fund because of the standard loss ratio. That means you're an average investor. And if you're a better investor, that might look different. And so same with the hedge funds that have moved over into lower valuations because things have stayed private longer. What you're really looking at is people trying to find alpha earlier for them to deploy capital at an earlier stage. And to make that a little bit less confusing, what I mean by that is you have just large amounts of capital at later stages, and they're trying to figure out how to get into valuation stages that used to be public and liquid, but they're now all private. So for example, if you were a company that had 100 million in ARR, you went public. Now you kind of think twice about it. 10 years ago, you could have been at 25 to 50 million in ARR and you went public. And now for sure you don't go public because there's private alternatives. Now, these later stage funds that have either formed or were public entities that invested in public markets no longer have access unless they start investing privately, start thinking about how do they allocate capital across all the life cycles of a company's existence, from primordial stage to pre-product market, to product market fit, to post-product market fit, to scale fit, and how they deploy capital. So it's really all about risk attribution. And I don't think there's any right or wrong way. We do this too. We invest in pre-seed and seed, but primarily we think about investing Series A and Series B. That's where most of our capital goes. So $5 million checks to $15 million checks at the high end. Everyone thinks about it differently, and I don't think there's a right or wrong answer. It's just all funds are thinking about different ways of deploying capital at different stages.
Yeah, I wanted to add one little bit onto that. Regarding the structural change, I think one structural change that's really happened over the last 10 years is that the nomenclature for funds has completely spread out. Basically, no term means anything. Right? You could be seed and you can be huge, you could be small, you could be Series B, whatever. Just to give you some sense, when we say Series A here at Tribe, we believe Series A to be the time when you, the entrepreneur, believe you have product market fit. And we've written a lot about product market fit, how to measure it, how we think about it. And that's how we think about Series A, is about that time when, in seed, you don't yet have product market fit. You have a product, you're trying to figure out product market fit. Series A, presumably you have it now. And Series B, okay, now you're a real business. Right? You no longer are a product with product market fit, but you are a fully fledged company. That's the nomenclature we use. By no means is that standardized. Everybody sort of has their own, but that's what we tend to think.
Yeah, to echo what Jonathan said, you could have a Series A company that's raising at 35 million post, or 100 million post, or $500 million post. And we've invested in a Series B company where it was $1 billion post. And so the nomenclatures of Series A and B is not what we like to go by, because one, it's not quantitative, it's just this term that people use. And so we like to look at valuation stages, which is at the early primordial stage, what is it worth? At pre-product market fit phase, certain demand signals, what is it worth? And how do you underwrite risk that way?
I'll just add one more thing from the perspective of reporting on this. We've certainly seen the collapsing of the funds and everything the team at Tribe said. I do think there's a little bit of a question mark over how long that might persist. I mean, I think it's definitely like the mega trend as it's happening and it's not going to reverse, but it of course doesn't mean that all investors who are going to be successful across all stages. In fact, I don't know if you guys remember the YC became a late stage investor several years ago with the Continuity Fund. I'm not sure, maybe the Tribe team knows more about what's happened to that, but it doesn't seem like it's been a huge focus. So I think we also have to approach this with a little bit of skepticism about, funds that might try out, going earlier, but then retreat if they find that it's not their sweet spot. We've definitely seen that. And so I would, oh, Jack, you need to be muted. Okay. So if you're entrepreneurs, I would keep that in mind with a little bit of caution if you're looking at someone who has a track record in one space. I would also really check their commitment to that. Their LPs might push back as well. So, and then lastly, look, I think the late stage crossover that Arjun mentioned is very much in the air with what we've seen with the recent IPOs. So I don't know that we're going to see Fidelity and T. Rowe go as aggressive in the private markets, which again, they were doing really to get some data to help build their models for these companies that they're going to want to own as public shareholders. I think there is a very large question mark around that type of crossover. Do we have maybe one or two more questions as we approach the 45-minute mark? Go ahead. I had a question come in asking how much whether someone led a round was a factor in the methodology. Tribe, could you help me answer that one?
Yeah, I can speak to that a little bit. When we were thinking about whether or not you lead the round, I think the more important question was how much ownership did you get when you made the investment? And in reality, when we think about how that would have actually flowed through when we were trying to quantify everything, it's actually a very, very hard question to go from there. And partially because of the availability of data, but also because of the variance that will introduce in terms of like then you start to bite off the whole returns piece, which is very, very hard to get a clear signal out of. So when we thought about it, we actually went simpler. We tried to just say, where are you spending your time? How, and try to get enough small data points that we could construct a general picture of the way that you as an investor might be making decisions. So, does that answer, does that help out a little bit? We were trying to look broader and simpler without focusing too much on ownership when we're kind of looking at track records.
We just saw a quick question flash across the screen, which I thought was a great one. What surprised you or broke down in the analysis?
There was a lot. So you guys have only seen the top 10, or sort of the 10 best that are generalists. But we cut through a lot of the data for certain ways in which we wanted to understand how we should be spending our time as investors and who might be good, who might not be. I think there was a question earlier about by Nancy about sectors. Where a lot of it was that we found out that there were people of color and genders that were top performers as individuals when you looked at attribution that don't show up in a lot of lists that we've seen before. There were these new funds that we had never heard of that invest in the domestic United States that were based out of Israel and Canada that we had never heard before, but they had an amazing portfolio and they were highly active and they had a great brand with founders. And so I think a lot of it was because we had a non-biased approach to quantifying who's a good seed investor, we started uncovering a lot of funds that are out there that are just heads down, do the work. Some were biotech related, and focus on sectors that we may or may not want to spend time on. But it ended up being a list that some names were familiar, but I would say 25 to 30% of those names were just total outliers that we had never heard before, and we decided to look into that further.
Which is part of the goal, to find a list that is not super correlated to Twitter.
Excellent. That's a new tagline, guys. Okay, let's do one more question, and then I want to be mindful of people's time, but we can wrap up by telling people how you can reach us once this concludes with any further questions. I just saw one pop up that then went away. Let's see.
Got it.
Okay.
Is there a data gap that if firms or startups or third parties could start providing would improve your findings?
Sorry, can you repeat that one more time? We didn't hear you.
Yeah. Is there a data gap that if firms or startups or third parties could start providing that would help improve your findings?
Yes, of course. I think our approach is the more data we can get about everything that happens, the better that we can inform our own methodologies as well as present it back to the public. And so, anything the company does, what their ownership cap table looks like, is always super helpful. And we know we've partnered with some folks before to help them with this analysis because it's very hard. And it's general attribution, who's doing what at what time frame, what the exits look like, what do the exit actual numbers look like versus the ones that are published. We had to do some of that own work ourselves manual. We were able to do it for like a top 100, but imagine when you start getting into the top 1,000, top 2,000, or you get into biotech. There are different areas, unfortunately, that are a little bit more secretive about what they do, and I think we would love to spend more time thinking about healthcare, education, tech, bio, semiconductor, which don't get as much attention, and we had some fun looking through that industry when we got some names.
I would just add also from our perspective, and the team at Tribe has also been crunching this data when it comes to individual investors at the firm, and that is something that we want to continue to work to present. from my experience, some venture firms aren't even in agreement on who led which round internally, or which investment. So that's obviously sort of a tricky area, but an area where I think we can continue to add value as well without maybe getting drawn into internal fund infighting. Excellent. So with that, I want to thank you all for participating in our first video call. It's really nice to see some faces. You gave us some great ideas, and we're going to continue to work with Tribe on this data and ways to present it. Please do check out the list if you haven't. There's a lot of reporting in there from Amir and Zoe as well to sort of supplement that. I will also add that for our corporate subscribers and our team subscribers, we do more personalized one-off briefings like this. So if for any of our conference calls, you're wondering if you'd like to go deeper and in a specific vein for your company, just email groups@theinformation.com and we can tell you more about our corporate programs. With that, I'm Jessica at The Information at any time. Tribe team, what's the best way to get in touch with you guys?
We have an email, hello@tribecap.co. Feel free to reach out to us. I promise you we will respond at some point.
Excellent. Well, thank you all. Have wonderful weekends. And we're going to stick with this video format. And coming up in the coming weeks, we're going to be doing a lot of 2020 previews and 2019 look backs. And so look forward to hopefully seeing many of you on those calls as well. Have a great day.
Thanks for having us.
Thank you all.